We are still on IAS 16, property, plant, and equipment. In the previous video, we looked at the definition of PPE, we looked at the examples of PPE, and we looked at the initial measurement of PPE, where we said PPE is initially measured at cost. And then we learned, or we looked at what goes into the computation of cost, right? What do we include and what do we not include? We looked at all those stuff. And then we mentioned that when PPEs are purchased on deferred settlement basis, where you purchase the PPE and you pay in the future, if the duration or the period is a year or more, then we discount that amount to present value because there's a financing element, right? It means that the seller is charging you some component, some interest for deferred settlement, and therefore we don't have to include that component, and therefore we have to discount that amount to present value before we record it in the books. And the difference between the present value and the future value is called the finance cost. That's the financing element, which is recognized in the statement of profit or loss. All right. Now, let's look at the subsequent measurement of PPE. But before subsequent measurement, let's look at this before we come to the subsequent measurement. There's something I want us to look at, something called the subsequent expenditure of PPE. So we learned how to recognize or what we do with the initial expenditure or the initial cost of PPE, and then whether we are going to add or not. We looked at all those things. What about the subsequent expenditure? Okay, when the PPE is ready and you carry expenditure, what do you do with that subsequent expenditure? All right. Let's say your building is ready, you started depreciating it. Now you've incurred another expenditure on the PPE. How do you treat it? So that brings us to what we call the subsequent expenditure. All right. So the standard says subsequent expenditure related to an asset can be recognized or capitalized as PPA if. So we have two conditions under which we can capitalize subsequent expenditure. Other than that, all subsequent expenditures are written off to profit or loss. So if the expenditure meets these two criteria, then we capitalize it. If it doesn't, we expense. So it says if it improves here. Okay, let me change my color. I really like this color. When it improves or expands the capacity of the asset, for example, by enhancing its performance or extending its useful life. So when that subsequent expenditure will improve or expand the capacity of the asset, and then when it replaces economic benefit already what consumed, right? Let me give an example. It replaces economic benefit already consumed. It says provided that the part that it replaces is treated as an item that has been disposed of. So let's say you have an aeroplane, right? You have an aeroplane, and the aeroplane has components. So we have the engine, then we have the seat, okay, then we have the body or the part, right? I mean the main body part. Now what we are saying is that, okay, let's say the engine has useful life for 5 years and therefore it's fully depreciated, right? The engine has a useful life for 5 years and it's fully depreciated, all right? Then you buy a new engine. If you buy a new engine, the new engine you are buying, okay, will replace the old engine, and therefore it is replacing economic benefit already consumed, all right? So when it replaces economic benefit already consumed, then we will capitalize it because we had the old engine, we used it. Now we are bringing in new engine. So the new engine is replacing the old one. So it's replacing the economic benefit that has already been consumed. So in that case, we capitalize it. The same thing. Let's say you have a building, okay, maybe 2, 3, 4 bedrooms. Then you decided to construct a pavement in front. All right. Now, that pavement you've constructed in front or the expansion you've made in front should be capitalized. Expenditure on that should be capitalized. Why? Because you are improving or expanding the capacity. See, you are adding the pavement. So you are expanding the capacity of the asset. So in that case, we'll capitalize that what expenditure. So that the expenditure on the pavement, okay, maybe adding another block or adding another room or expanding the front. I mean, all those costs should be capitalized because you are improving or you are expanding the capacity of the asset. So these are the two conditions under which subsequent expenditure will be capitalized. When it improves or expands the capacity of the asset, you expand the capacity, okay, or it replaces economic benefit that has already been consumed. Example is the engine. You've used the engine, you are buying new engine, and therefore you are replacing the old engine. You are replacing economic benefit already consumed, and therefore you have to capitalize it, right? So it says otherwise expenditure must be written off towards profit or loss. And it says repairs and maintenance. So repairs, we know if you do any repair and what maintenance, we write them to what? P or L. Don't forget, repair and maintenance are revenue expenditure, and therefore they are written off to profit or loss. Now let's look at the subsequent measurement of PPE. We said PPE is initially measured at cost. Subsequently, we said we can use the cost model or the revaluation model. If I use the cost model, then what it means is that to get the carrying amount or the carrying value of the asset, you pick the initial cost, then you less accumulated depreciation, and you also less accumulated what? Impairment losses. All right. So we have impairment covered by a different standard, right? IAS 36, IAS 36 impairment, right? So that's it. Basically, if you are using the cost model, the carrying value will just be the cost, initial cost minus all accumulated depreciation you've charged. If you've also recognized impairment losses, then you also less the accumulated impairment losses and get the carrying value. Now, if you are using the revaluation model, okay, if you're using the revaluation model, then what you do is that to get the carrying value, okay, to get the carrying value, all right. Now, the carrying value will be the fair value at the date of revaluation, okay, minus subsequent accumulated depreciation and subsequent accumulated impairment losses. But let me tell you something. Whenever you revalue an asset, it removes all previous accumulated losses and all previous accumulated what? Depreciation. All right. So if you revalue your assets to let's say 50 million now, then all previous accumulated depreciation and all previous accumulated impairment losses you recognize no longer exist. This now becomes the new carrying value, and therefore we only deduct subsequent what? Depreciation or subsequent impairment losses, right? So let's say you did a revaluation on 1st January 2026. If you do the revaluation on 1st January 2026, all right, and it's 50 million, then the 50 million becomes the new cost. In quote, it becomes a new cost. And therefore, you deduct depreciation or accumulated impairment losses from January going. The previous ones will not be deducted again. Because if you revalue the asset, it's like you're buying a new one. So it clears or removes all the previous accumulated impairment losses and accumulated depreciation that you've recognized. It clears them off. So this becomes like the new, in quote, cost. Okay. So don't forget the revalued amount becomes, it's always now the new cost. Okay. And therefore, to get the new carrying value, it will be the new revalued amount or the new fair value. Then you less subsequent what? Not the previous. That's why it says what? Subsequent. So after the revaluation, the depreciation and impairment losses after the revaluation is what you deduct to get a new carrying value. We'll look at more into details, right? For cost, it's very simple. So let's look at revaluation. It says no cherry picking. What do we mean by no cherry picking? Let's say you are walking on the street and you see a mango tree. That mango tree has bears and fruit. So you have like 4 or 5 mango fruit on the tree. Then you go and plug one and leave the rest. No, that's what IAS 16 prohibits. It says no cherry picking. You can't go and pick one class of asset. You can't go and pick one PPE. We can't pick one item of PPE and revalue it and leave the rest. That's why it says if an item of PPE was revalued, one item of PPE is revalued, then the entire class of PPE to which the item belongs must be revalued. So you can't just pick one item of the PPE and revalue it. No. The entire class must be what? Revalued. And I think this question was something like ICAG the Institute of Chartered Accountants Ghana. It was one of their past questions or something like that. Yeah, if I'm right, or ECC. No, I think the ICAG. Yeah, I remember. And they tried to give them some scenarios about this revaluation. Right, we'll go through those questions. So just know that there's no cherry picking in IAS 16. If you revalue one class of asset, then the entire class, or if you revalue one item of PPE, then the entire class to which that PPE belongs must also be what? Revalued. Okay. And it says in practice often carried out every 3 to 5 years. Yeah, but it depends on the entity or the company. All right. But basically, revaluation should be done every 3 to 5 years. But as I said, it's not fixed or something. It's a policy. Other companies choose when to um, do the evaluation. All right. But we have to do it regularly to ensure that the current value does not differ materially from what the fair value. Okay. And it says on revaluation, the fair value or the revalued amount is compared to the current value. So if you are revaluing, you compare the current amount with what? The revalued amount or the fair value. Okay. So look at that. So that's no cherry picking. If one item of PP is revalued, then the entire class to which the PP belongs should also be revalued. So still on revaluation. So we said to get our revaluation loss or gain, we compare the current value with the revalued amount. Okay. So if the current value is greater than the revalued amount, okay, what happened? Is it loss or gain? And when the revalued amount is bigger than what? The current value, or is greater than the current value, do we have a loss or we have a gain? All right. So we'll look at these things here. So note that if the revalued amount is bigger than what? The current value, then there's revaluation what? Gain. Don't forget that. For example, if the current value is 50 million, then the revalued amount is 70 million. Yeah, there's a gain of what? 20 million. All right. There's a revaluation gain of what? 20 million. So don't forget that we get revaluation gain when the revalued amount or the fair value is greater than the current value. So where the revalued amount or the fair value is greater than the current value, we have a revaluation gain. And then when the revalued amount is less than the current value, or the current value is rather more than the revalued amount, then we have what? Revaluation loss. So for example, let's say current value is 30 million, revalued amount is 20 million. You see here there's a loss of 10 million. There's a revaluation loss of 10 million because the current value is more than the revalued amount, or the revalued amount or the fair value is less than the revalued amount. So note that. All right. So revaluation leads to what we call loss or gain on revaluation. And how do you treat this loss or gain on revaluation? Now, people use formulas, but it's not from like just get understanding. They say if this is this, if you arrive for the first time, if you are revaluing for the first time, do this. If for the first time there's a loss, do this. First time gain, do this. If there's this formula, there's no formula. One thing you have to know is that there's something called the revaluation surplus account. The revaluation surplus account is an account that houses revaluation gain. So if there's any valuation gain, you put it in the revaluation surplus account. So the revaluation surplus account is an equity item which houses, which what include or which contain what? Revaluation losses and gains. All right. Just know that the revaluation surplus account can never be negative. That's all. If there is any gain or loss, the general rule is that revaluation losses and gains. So let me write it here. Gains or losses are recognized in what? The revaluation surplus account. If you go to the profit or loss and other comprehensive income, then under OCI, we record them in what? OCI. I mean, in other comprehensive income. So we put them under OCI. So when there's revaluation loss or gain, we record them in what? Revaluation surplus account. Okay, revaluation loss or gain are recorded in revaluation surplus account. But just know that the revaluation surplus account cannot be negative. That's all. That's the rule. So let's say you have a revaluation gain year one. You made a gain, valuation gain of 10 million. Let me say 100 million. Record this 100 million in what? Revaluation surplus account. If year two, you make a loss of what? 80 million. Still record this loss in revaluation surplus account. Why? Because there's a balance in a revaluation surplus account. There's 100 million gain there. So the 80 million loss can be used to reduce the 100 million gain. So now the balance now was 20 million because you had a gain of 100 million. You recorded it in the value surplus account. Now you have a gain, now you have a loss of 80 million. That loss will be deducted. Okay, so you have to reduce the balance with the loss. Now you'll be left with what? 20 million. So the loss will be deducted. You have 20 million. Then let's say year three, you have a further loss. You've made a revaluation loss again of 50 million. What do? You realize that in year two or at the end of year two, there will be 20 million balance in the revaluation surplus account. We had a gain of 100 million. We had a loss of 80. So we use the 80 to reduce the 100 and we have 20 gain. Now you've made a loss of 50. You see, you can record all the revaluation loss in the revaluation surplus account because we only have what? A gain of what? We have a balance. Let me see, balance of only 20 sitting in the revaluation surplus account. So out of this 50 million loss, you can only record 20 million loss in the revaluation surplus account. Now the surplus account is now zero. There's no balance again. Then the remaining 30 million loss, you record it in what? P or L. That's all. The bottom line is that the revaluation surplus account cannot be reduced to zero. Sorry, it cannot be reduced below zero. So the bottom line is the revaluation surplus account cannot be negative. It cannot fall below zero. The revaluation surplus account cannot be negative, cannot fall below zero. So if you have a gain, put it there. If you have a loss, use the loss to reduce the gain. But as you are reducing the gain, with the loss, check the gain. If it's reduced to zero, okay, no loss can be recorded there again. The remaining loss will go to P&L. If again, let's say year four now, we make a gain of 50 million. Because we have recorded a loss of 30 million in P&L, we will take 30 million also to what? P&L. To gain what? We'll take the 30 million gain to P&L to go and clear the loss. Okay, so out of the 50 million gain, we'll take 30 million gain to P&L to go and clear the loss of 30 million. Then the remaining 20 million gain goes back to what? Value surplus account. I hope you are getting it. So the bottom line is that revaluation losses and gains are recorded in revaluation surplus account. Some say other OCI. We will look at those things, right? So record them in revaluation surplus account. And we are saying that the revaluation surplus account cannot have a negative balance. So if there's a gain, add. If there's a loss, be deducting. But if you keep deducting and then the balance is zero and there's still loss, take the loss in P&L. And then when you make a gain, take the gain again to P&L to go and clear the loss in the P&L. Then excess gain will go to what? Value surplus account. So let me use figures to demonstrate this. This is very important. So let me use figures to illustrate this. Okay. So let me wipe these things here. So let's say year one, you made a gain of 100 million. So what we are saying you do is that you debit, okay, the asset, you debit PP, and you credit your revaluation surplus account with 100 million. So see, now we have 100 million in the revaluation surplus account. Let's say year two, you made a loss of 250 million. What do? You see, in the normal sense, you are supposed to record the loss in revaluation surplus account. But the revaluation surplus account has only a balance of what? 100 million. So you can't record the whole 250 loss there. We can only record 100 loss there. So out of the 250 loss, we'll take 100 to revaluation surplus account to go and reduce the revaluation surplus account to zero. Then the 150 loss, remaining loss, will go to P&L. What you do is that you debit your revaluation surplus account with what? 100 million. Then you debit P&L with what? The remaining 150. Then the whole credit will hit what? Your PPE, 250. So can you see how it works? So now we have a balance. Initially, we're having a balance of 100 million in the revaluation surplus account. We made a loss of 250 million. So out of the 250, we take 100 to the revaluation surplus account to go and reduce the balance to zero. Then there will still be a loss of 150, which we record in P&L. That's why I debited P&L with 150 and I created revaluation surplus account. Then let's say year 3, you made a gain of 400 million. What do? Don't be in a hurry to take the gain of 400 million to P&L. Don't be in a hurry to record the gain of 400 million in OCI. We know it's a gain. So but don't be in a hurry to record it in value surplus account or OCI. No. Don't forget you have already recognized valuation loss in P&L. Okay, valuation losses are not supposed to go to P&L. But because there's no balance in the value surplus account, that's why we recorded the loss in P&L. There's no balance, a gain left in the value surplus account. So we recorded the balance in P&L. So if you have a gain, also use the gain to go and clear the loss in the P&L. So with this 400 million, don't forget we recorded what? 150 loss in P&L. So we have to go and credit P&L. So you credit P&L with the 150 so that we eliminate, we go and clear off what? The loss. Then there will be another credit, which the difference will be what? Now 250. So the remaining 250 will now go to what? We'll go to the value surplus account. Okay. Then we'll debit PPE with what? The whole 400. So you see, because we previously recorded loss in what? P&L. When we had a gain, we also have to use the gain to go and reduce or to go and eliminate the loss. Okay. So out of the 400 gain, we use 150 to go and clear the loss. Then the remaining 250 will now go to the value surplus account. Okay. So that is that. So that's what we talked about. Okay. So if you look at this place here, that's what is said here. All right. That that if the revalued amount is more than the if the current value is rather more than the revalued amount. Okay. Let's say you are doing the revaluation in the first time and the current value is more than the revalued amount, meaning there's a loss. If there's no balance in the revaluation surplus account, because you are making loss for the first time, you can't take the loss to what? Revaluation surplus account, because there's no balance and the revaluation surplus account cannot be negative. So if you're making loss for the first time, then what you do is that you debit profit or loss, meaning you take the loss to P&L. Okay. And then you debit P&L, you credit the asset. So you record the loss in P&L. Then subsequently, if there's a gain, okay, then use the gain to do what? To go and clear the loss there. So if there's a gain, subsequently, then do what? Credit P&L. So that's what we have here. The debited P&L. Why did you debit P&L? Because it was valuation loss for the first time and there's no balance in the revaluation surplus account. All right. But if there's a balance and then there's a loss, they have to debit the revaluation surplus account and credit the asset, meaning you have to take it to what? You have to take the loss to what? The revaluation surplus account to go and reduce it. All right. Okay. So don't forget that if there's a first time loss and there's no balance in the revaluation surplus account, then we have to record a loss in P&L. So we have to debit P&L and credit the asset. Okay, then we have disposal of revalued non-current assets. When non-current assets that were previously revalued are disposed, what do? For that one, we know the normal thing. Profit or loss on disposal is recognized in the profit or loss account. Okay. So if you make any profit on disposal or loss on disposal, then it is recognized in the P&L account. How do we get profit or loss on disposal? You compare what? you compare the carrying value with what? The proceed. Don't forget that. So if carrying value is, let's say, 50 million, but you sold it for 70 million, then you have 20 million gain on disposal, which will be recorded in profit or loss. So whether the asset is previously revalued or not, profit or loss on disposal is always recorded in P&L. Whether the asset is realized, whether the asset is revalued or not. Okay, whether the asset is revalued or not, profit or loss on disposal is always recognized in profit or loss account. So to get the profit or loss on disposal, compare the carrying value with the proceed. As at the time you are selling, what's the carrying value in your books? Okay, you compare it with the amount you are getting from selling, the proceed. All right, so if the proceed is more than the carrying value, it's a gain. If the carrying value is more than the proceedings, it's what? Loss on disposal, which are both recognized in profit or loss account. All right, so don't forget, if the carrying value is less than the proceed, or if the proceed is more than what? The carrying value, then here there's a gain on disposal, goes to P&L. If this is greater than the proceed, if the carrying value is bigger than the proceed, then there's a loss on disposal, which is also recorded in what? P&L, irrespective of whether the asset has previously been revalued or not. Then there's one interesting provision here, which I want you to know. It's not common, most people don't know, but very important. Example, if you want to be a chartered accountant, if you want to write professional exams, you have to know these things. You don't have to only know the common principle that everybody knows. You have to know stuff in details. It says IAS 16 allows but does not require here the transfer of what? A revaluation surplus to retained earnings when the asset to which it relates is derecognized or realized. This might happen over several years as the asset is depreciated or at a point in time when the asset is sold. So what they're saying is that, let's say your revaluation surplus account, you have a balance of 50 million in the revaluation surplus account. You did revaluation, you had a revaluation gain of 50 million, and therefore you placed it in the revaluation surplus account. But you sell the asset. Now, this is what IAS 16 is saying. Like, IAS 16 is saying you can leave the 50 million in the revaluation surplus account, or you can transfer it from the revaluation surplus account to retained earnings. That's the rule. That's why it says IAS 16 allows but does not require here. So IAS 16 is saying if you revalue your asset and you have revaluation gain, okay, in the revaluation surplus account, there's a balance in the revaluation surplus account, and you sell the asset, you can either leave the revaluation surplus, the evaluation gain or the balance in the revaluation surplus account. You can leave it there, or you can leave, or you can carry it, or you can transfer it from the revaluation surplus account to retain earnings. In that case, you dissolve the revaluation surplus account. So you are going to transfer everything. So if you are doing the transfer, then what you do is that is it revaluation surplus account has a credit balance, so you debit it. You debit revaluation surplus account and you credit what? Retain earnings. Why? You are moving it from revaluation surplus account to retain earnings. So you have to debit revaluation surplus account with the balance there, so that the revaluation surplus account will be zero, and then you close it. Then you credit retain earnings, meaning you add it to retained earnings. So please, this one principle, most people don't know, but please, you have to know. All right. And then there's also another principle which I also want to let you know. Okay, this disclosure requirements, derecognition and stuff. Okay, now before we continue, there's also one principle that I want you to know. Okay, that's also another transfer. So we've seen one transfer here. We said if the asset is sold and there's still balance in the revaluation surplus account that relates to the asset, then the standard is saying what we can do is that we can transfer the balance to retain earnings and close the revaluation surplus account, or we can leave it there. There's another thing you have to know. It's also a transfer. What is it? Sometimes you see, if you revalue your asset upward, revaluing your asset upward creates what we call revaluation. It creates revaluation gain, or it increases the current value of the asset. And you see, if there's revaluation gain, okay, subsequent depreciation is based on the new revalued amount. So if you revalue your asset upward, it will increase depreciation charge for the year. Depreciation charge for the year to when it increases, it reduces profit. If depreciation increases, profit is reduced. And therefore, if your profit reduces, retained earnings will reduce. So that's, don't forget, that's one impact of revaluation on profit. If you revalue your asset upward, I said upward, it increases what? The current value of the asset. And increasing the current value will increase subsequent depreciation charge. And when depreciation charge increases, depreciation and expense. So if depreciation increases, profit reduces. So the standard is saying if that's the case, then we have to also transfer again from the revaluation surplus account here to also to retain earnings. But here is the difference between the depreciation without the transfer, or depreciation without revaluation, and depreciation with revaluation. This is what I'm saying. Let's say your asset costs 20 million. Useful life is 5 years. So you say that depreciation will be what? 20 million over 5, which is 4. 5 for 20, yeah? Okay. Now, so it's like current value will now be 20 minus 4, which is 16. Right? So current value will be 16. Now, let's say you revalue your asset from the current value, that's the 16, to, let's say, 36 now million. You see, you have revalued 36 million now. So let's charge the depreciation. So your new depreciation now will be the 36 million over the remaining useful life, 4 years. It was 5 years, you charge depreciation 1, so it will be 4 years. Now, if you divide 36 by 4, okay, what will be the new depreciation now? I'm getting 9 million. So get the difference. You see, without revaluation, depreciation was only 4 million. With revaluation, with revaluation upward, it has now moved towards 9 million. So you see, depreciation has increased, and when depreciation increases, we are underestimating our profit, but profit will reduce. Okay, by the difference. So what's the difference between the two depreciations? That's the what? The 9 million. That's the depreciation with the revaluation, and then the 4 million depreciation without revaluation. So it's 5 million. So this 5 million, the standard is saying, okay, if you revalue your asset upward, you are going to reduce profit by what? 5 million. That's the excess depreciation. So if that's the case, if you reduce profit, return earnings will reduce. So what you do is that transfer 5 million from the revaluation surplus account to retain earnings. So what it means is that debit your revaluation surplus account 5 million and credit retained earnings 5 million. So you are transferring the 5 million from the revaluation surplus account to the retained earnings to make up for the shortfall in profit as a result of what? The revaluation. I hope it's clear. So that's also one transfer. Sometimes they can tell you the question. They make transfer from what? Revaluation surplus account to retained earnings or to retained profits. That's what it is. And this is created as a result of what? Revaluation upward. Because when you value your asset upward, it's going to impact depreciation. It's going to increase depreciation, and increased depreciation leads to reduced profit. And reduced profit also leads to reduced retained earnings. And therefore, we have to take a component, a portion of the revaluation surplus account equal to the excess depreciation and take it to what? Retained earnings. So we debit value surplus account and we credit retained earnings. So this also transfer. So you see with the two transfers. Now ask yourself, did you know these two transfers in PP? It's clearly in the standard. So if you want to, you have the aim of becoming a chartered accountant, then you have to know these things. All right. You should know these things. You should be familiar with these things. All right. So this is also another transfer. You can put it somewhere, make a note. And the disclosures, yeah. So the disclosures, so many depreciation charge for the year. And I keep telling my students depreciation, or sorry, I keep telling my students disclosures is nothing. Disclosures is what you've done in the main work. I mean, what the standard talked about. That's it. It's like a summary. So disclosures of IAS 16, you can talk about depreciation charge, the method of depreciation is straight line reducing balance, Did you revalue your asset? If you revalued it, is there any is there revaluation loss or revaluation gain? Has any PP been disclosed? Is there any impairment loss? All these are the disclosures. These are the things you have to disclose, right? And last, finally, we have what we call a derecognition. Derecognition means you are taking the asset from your books. You see, we did initial recognition. Now we want to derecognize. So when do you record, or when do you remove the PP from your books? When do you remove it? When do you derecognize it? Right? So we say derecognition arises when the asset is sold, is disposed of, or when there is no future economic benefit expected from the asset. Don't forget, we said we recognize PPE when two conditions are met. One, when future economic benefit associated with the PPE is expected to flow to the entity, and two, when the cost can be measured reliably. Do you remember? This is when no future economic benefit is expected to flow again, then remove it. So this is it. So derecognition is in two main forms: either disposal or no future economic benefit expected to come to the entity again or flow to the entity. And he said gain or loss on derecognition, which is more like gain or loss on what disposal. You compare the net proceed with the carrying amount. So I told you to get profit or loss on disposal is equal to your proceed. You compare it with the carrying value or the carrying amount. And this proceed is said net because sometimes as you are selling, if you sell, you get money though, but sometimes you also incur some cost to sell. So you have to net it from the selling price, and that will give you the net proceed. The net proceed will be like the selling price net cost to sell, and that will give you the proceed. Then you're going to compare with the carrying value. And I told you if the proceed is more than the carrying amount, then this is what a gain. If the proceed is less than the carrying amount, then there's a loss, both of which are recorded in P&L. And it said it's accounted for as gain, no revenue, meaning you take it to other income. Okay, not as revenue, because the entity doesn't deal with sale of PPE. So PPE gain on disposal, they are incidental. Okay, so that's it. And then we are not done. As we are solving the questions, we will also be looking at some provisions. I think I'm happy I talked about the two main transfers. The next thing we'll be looking at is review or revision of useful life and revision of what the residual value. Okay, but those ones will do it, which is more like accounting policies, which is more like IAS 8. Yeah, accounting policies, changes in accounting estimates and errors. It's more like IAS 8. So with these areas, we'll be looking at them as we are solving questions. Okay, but we've covered enough, and I'm very happy we've covered enough. Right, so let's end here. In the next session, we'll go back to our tutorial questions. Don't forget, they are here patiently waiting for us. Okay, plenty questions, and I can't wait to solve question 13 and 14 with you guys because it looks a bit complex, but it's not. It is question 13 here, and then 14. Okay, we even had purchases there. I think we had some trading. No question. Which one had the trading? Okay, I think question 13 has some trading there. Sometimes you do some trading. Yeah, this one trading. So we'll solve this question. So let's end here. Yeah. So in the next session, we are done with the theory side. So you know the principles. In the next session, we'll be solving the practical questions. All right. So that's it with this session. Thanks for watching. But once again, CN Professional Institute is an accredited tuition provider for your professional exams. So you want to be a chartered accountant, that's the Institute of Chartered Accountants Ghana. You want to charter in taxation, become a chartered practitioner. You want to write your ACCA exams. So we are here to help you pass your professional exams. All right. So my team, we are here, competent lecturers, competent tutors. All right. So we train students and then they perform very well in the exam. So you can register with CN Professional Institute. We also have scholarship packages available. All right. So you can also contact us and equally join CN Professional Institute on scholarship. All right. So let's end here. I'll see you in the next video. Bye bye.